Welcome, ladies and gentlemen, to Boss Economics World, the only show where we take the dismal science, sprinkle it with a dash of chaos, and serve it up hotter than a central bank printing press during a recession. I'm your host, the Sultan of Satire, the Maestro of Markets, and the guy who thinks quantitative easing sounds like a yoga move gone wrong. Today, we're diving headfirst into the economic circus that is Europe's grand plan to dethrone King Dollar and crown the euro as the new global financial monarch. Spoiler alert, it's a plot twist juicier than a Netflix drama, but with more bureaucracy and fewer car chases. So, grab your calculators, your popcorn, and maybe a stiff drink, because this is gonna get wild. Let's set the scene, folks. It's August 13, 2025, and Europe's policymakers are riding high on a wave of optimism, or is it delusion? Ever since Donald Trump swaggered back into the White House, the global economy has been hit with more shocks than a lightning rod in a thunderstorm. Tariffs flying left and right, the Federal Reserve under siege, and U.S. Treasuries looking about as safe as a house of cards in a windstorm. And in the midst of this chaos, the euro, yes, that plucky little currency that's been the dollar's awkward cousin for decades, has decided it's time for a glow-up. Christine Lagarde, the queen bee of the European Central Bank, is leading the charge. Back in May 2025, she dropped a bombshell, declaring that the uncertainties about the dollar's role have created a global euro moment. Translation: the dollar's having a midlife crisis, and the euro's ready to slide into the DMs of global investors. But here's the kicker, taking on the dollar isn't just about flexing some monetary muscle. It's about dismantling decades of economic fragmentation, political squabbling, and good old-fashioned European bureaucracy. So, let's break this down, Boss Economics World style, and see if the euro's dream is a blockbuster hit or a straight-to-DVD flop. First, let's talk about why the euro even wants to crash the dollar's party. The US dollar isn't just a currency, it's the Beyoncé of the financial world, flawless, untouchable, and running the show. This dominance, dubbed the Exorbitant Privilege by former French Finance Minister Valéry Giscard d'Estaing, gives the US some serious perks. Lower borrowing costs? Check. Insulation from exchange rate volatility? Check. The ability to slap sanctions on anyone who looks at Uncle Sam funny? Double check. According to the Bank for International Settlements, as of 2024, the dollar accounted for 88% of all foreign exchange transactions and 59% of global foreign exchange reserves. Meanwhile, the euro? A measly 19% of transactions and 20% of reserves, per the ECB's latest report. Ouch. But here's where it gets spicy. Trump's return has turned the dollar's throne into a hot seat. His tariff tantrums and Fed bashing have spooked investors, with a Natix's survey in 2025 naming Treasury market turmoil as the top risk for global markets. U.S. Treasuries, once the gold standard of safe haven assets, are now looking shakier than a Jenga tower at a frat party. And guess who's waiting in the wings, batting their eyelashes at investors? That's right, the euro. With Germany loosening its fiscal purse strings and growth prospects perking up, the euro's suddenly looking like the new kid on the block everyone wants to hang out with. But hold up, folks. Before we start printing Euro, World Champion t-shirts, let's talk about the elephant in the room, or should I say, the 27 elephants in the room, because that's how many countries are in the EU, and they all have their own agendas. Here's the deal, for the euro to even dream of rivaling the dollar, Europe needs to stop acting like a dysfunctional family at Thanksgiving dinner. Right now, the Eurozone is a patchwork quilt of national interests, fragmented markets, and enough red tape to wrap around the Eiffel Tower, twice. To take on the dollar, Europe needs deeper, more liquid capital markets, a unified bond market to rival U.S. Treasuries, and a political backbone stronger than a German Autobahn. But guess what? They've been trying, and failing, to do this for decades. Let's start with capital markets. The U.S. has a single, massive capital market that's the envy of the world. In 2024, the U.S. bond market was valued at $51 trillion, according to the Securities Industry and Financial Markets Association. Europe's bond markets, even when combined, are a third of that size, clocking in at around $17 trillion. And venture capital? Forget about it. In 2023, U.S. venture capital investments totaled $170 billion, while Europe scraped together a paltry $66 billion, per PitchBook data. Why does this matter? Because liquid, integrated markets attract investors like moths to a flame. Right now, Europe's markets are more like a flickering candle, cute, but not exactly setting the world on fire. Then there's the holy grail of euro dominance, a unified bond market. Imagine a world where Europe issues joint government debt, creating a eurozone equivalent of U.S. Treasuries. Investors would flock to these low-risk, euro-denominated assets, boosting the currency's global clout. Sounds dreamy, right? Well, wake up, because this dream has been stuck in limbo since the euro was born. Why? 2 words, national interests. Rich countries like Germany don't want to foot the bill for indebted nations like Italy, and small financial hubs like Ireland and Luxembourg are clinging to their tax advantages like life rafts. Lagarde herself has called out these national vested interests as the biggest roadblock. In November 2024, she noted that over 100 attempts to integrate capital markets since 2015 have crashed and burned. And let's not forget the army of lobbyists working overtime to keep things fragmented. Take Germany's Sparkassen banks, for example. These local savings institutions are fighting tooth and nail to protect their lending business from the big bad world of capital market financing. It's like watching a mom and pop shop try to fend off Amazon, adorable, but doomed. So, Europe's got the vision, but the execution? It's like trying to herd cats while riding a unicycle and reciting the EU Charter in Latin. Good luck, Christine. Now, let's pivot to something a bit more futuristic, the digital euro. Lagarde's been hyping this up as a key piece of the euro's global takeover plan. A digital euro, essentially a central bank digital currency, could make cross-border transactions faster, cheaper, and more secure, while also giving the euro a shiny new tech edge. According to a 2024 Beyoncé survey, 93% of central banks worldwide are exploring CBDCs, and the ECB is no exception. They've already launched a pilot program, with plans to roll out a digital euro by 2027. Sounds cool, right? But here's the catch, China's already miles ahead with its digital yuan, which has been tested in over $300 billion worth of transactions as of mid-2025, per the People's Bank of China. Meanwhile, the US is dragging its feet, with Fed Chair Jerome Powell calling CBDCs a solution in search of a problem. So, while a digital euro could give Europe a leg up, it's not exactly a silver bullet. And let's not forget the political hurdles, harmonizing privacy laws, cybersecurity standards, and monetary policies across 27 countries is about as easy as solving a Rubik's Cube blindfolded. A digital euro? Sure, it's shiny and futuristic, but if Europe can't get its act together, it'll just be another expensive toy gathering dust in the ECB's basement. Here's where things get really juicy. Lagarde's laid out 3 pillars for euro dominance: open trade, deeper capital markets, and the rule of law. On the first and third, Europe's got a solid foundation. The EU is a net exporter, with a trade surplus of €431 billion in 2024, per Eurostat, and it's a global champion of free trade. And the rule of law? It's literally a prerequisite for EU membership, unlike certain superpowers that treat international agreements like suggestions. But there's a fourth pillar Lagarde didn't mention: geopolitical clout. The dollar's dominance isn't just about economics, it's about power. The US has the world's largest military, spending $916 billion on defense in 2024, according to the Stockholm International Peace Research Institute. Europe? The EU's combined defense spending was $295 billion, with individual nations often pulling in different directions. Trump's pressure to rearm Europe has pushed the EU to launch its Rearm Europe plan, aiming to mobilize €800 billion for military investment. But let's be real, until Europe can project power on the global stage, the euro will always be the dollar's sidekick, not its rival. So, where does this leave us, folks? The euro's got a shot at greatness, but it's a long shot. The dollar's dominance is under pressure, but Europe's internal squabbles, fragmented markets, and geopolitical weaknesses are holding the euro back. Guntram Wolff, a professor at the Solvay Brussels School of Economics, sums it up perfectly: "I'm an optimist and think Europe will take steps in this direction, but my realism suggests the steps will not be big enough." Translation: Europe's got the ambition, but not the execution. And let's not forget the data. As of 2024, only 50% of Eurozone sovereign bonds are rated AA or higher, compared to over 100% of US GDP in top-rated treasuries, per Lagarde's own stats. Without a unified bond market, deeper capital markets, and a serious geopolitical strategy, the euro's global moment might just be a fleeting daydream. So, there you have it, folks. The euro's got big dreams, but it's facing bigger hurdles. Will it rise to the challenge, or will it stay the dollar's awkward cousin forever? Let us know in the comments below, and don't forget to like, subscribe, and ring that bell, because here at Boss Economics World, we're always keeping it real, even when the markets are keeping it surreal. Until next time, stay savvy, stay skeptical, and stay boss.